get ready with me while we talk about interest rates. So everybody's talking about interest rates, and no one's ever really talking about prime. And prime is what affects your variable mortgage. Prime is set by the Bank of Canada, and the Bank of Canada is looking at all the different things in our economy and what we should be setting this interest rate at. So if you think about COVID times when they set it really low and we all took out too much money and then our money wasn't worth as much, then they had to adjust so that prices weren't getting so expensive. And we recently had that Bank of Canada announcement last week where we said that it was going to hold. So people with variable mortgage rates didn't change. So if you hear people say things like it went up or it went down, they're usually referring to prime when they're talking about rates. And well, it's affected by the Bank of Canada. It is set by the banks. And it is set by the banks. And that is what we would consider the bank's base rate. So you might hear things like prime minus 0.8 or prime plus 0.2. And that would be your individual rate. So if you were to get a fixed mortgage, you would know that you're always going to be a certain rate above or below prime. And most of the time, if you're working with me, you're going to be below prime. So if prime goes up or down, your rate goes up or down. Now you may have heard of something, you may have heard of fixed rates, and that's what I'm in right now. Not what I would recommend at the moment. I would definitely recommend variable, but let's talk about fixed rates. Now fixed rates are not the same. Obviously, they stay the same, but they're not the same in how we calculate and where they come from. They're actually affected by bond yields. So sometimes that is already starting to, fixed rates start to change, and then the variable rate catches up. And that's not uncommon. And so if you have fixed rate or a variable rate, we might then talk about how is your interest calculated. And most mortgages use semi-annual compound to calculate your interest. Most do. What doesn't is something like a HELOC, which is a home equity line of credit. If you don't have a mortgage and you're a first-time home buyer, you might have an unsecured line of credit, which means it's not tied to your home. It's just a line of credit. And that's use simple daily interest. And then there's also another mortgage that uses simple daily interest. And that's the Manulife One mortgage. And that is what I believe is the best mortgage product out there. Not for everyone, but if you were to say what's my number one pick, that's what I'd pick. If you like to be strategic with your money, girl, I am not going to gatekeep. This is what you should be looking for. The Manulife One. Because it's going to calculate all the money that you have in your account each month based on daily interest. Okay, I'm doing the rest off camera. I'll be back. So I was just finishing talking about the Manulife One, and it's way too complicated to cover in this video, but most people I know and most clients I put in it, including myself, save about 7 to 8 years on your amortization, if your amortization is 25 years, of course. So it's going to save you like $100,000. Let's talk more. I can teach you so many things. Thanks for hanging out.